This conference will now be recorded.
So, as always, when we start our sessions, I wish everybody a good morning and thank you for joining us this morning for this session on how to prepare your business for sale. As always, before we start off, just to let you know that you can catch up on anything you may have missed on our YouTube channel. So go to Harts Limited spelt in full, and you'll be able to catch up on this webinar later on today and any other webinars that you may have missed as well. There's also some useful videos up there if you want to, on a variety of topics, which you can have a look at, all for free. Please feel free to use the speech bubble in the top right hand corner of your screen. Ask any questions in there, or if you want to unmute yourself, feel free to do so. We'll try and answer your question. And as usual, we have to have our usual disclaimer. So the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. We've got a quick government update. For those of you who may not have been on previous webinars, just to let you know that the businesses in the hospitality and leisure sectors, you're still eligible for these grants. So feel free to apply to your local authority. And the government's still covering the cost of statutory sick pay for COVID-related absences. That will be ending shortly. If you are struggling to pay your self-assessment income tax, you can still make an arrangement to pay online if you owe less than £30,000. And there is no penalty for late payment if an arrangement is made by the 1st of April. So you've still got time to sort that out. If you need any help with that, please let us know. National insurance rise of the 1.25% is coming in shortly from the 6th of April. The government have repeatedly said that this is definitely happening, so watch this space if it does. And it also applies to dividends as well. So if you're one of the many who take out their remuneration in the form of low salary and high dividends, you're also going to be hit with the 1.25% rise. And if you've not submitted your self-assessment return yet, you should have done, but due to a concession, you've got till the end of this month, in a couple of weeks' time, to avoid the £100 fine. Child benefit, as previously mentioned on previous webinars, HMRC are looking at this. So if one of you is earning over between 50 and 60,000, it gets abated, and over 60,000, you have to pay it all back. It's a crazy rule, so you can have husband and wife both earning £49,000 a year each, and they get full child benefit, and one of you might earn 60,000 and you get nothing. So just be aware of that. They are on the lookout for that. And the job retention scheme they are having a go at, and they have put proposals now to make company directors personally liable in certain circumstances. So if you've incorrectly claimed the COVID support scheme in relation to job retention scheme monies, now's the time to have a look at that and pay back anything you might have overpaid in error. The Let Property campaign is still open. So if you have not declared any income on your rental income on land or property, now's a good time to do it because there is very much a concession in relation to the amount of penalties you'll pay. Can be limited to just 10% penalties, and it's a good time now to actually do it. So if you need any further help on this, please get in touch on any of the above. Let us know. Have a look at our other online resources. So you can follow us on LinkedIn on Harts Limited, and you can subscribe to us on YouTube at Harts Limited and follow us at Twitter at Harts Accountants. And the next webinars, and we'll come on to this a bit later on as well, is the next one is on the 3rd of March. So it's all you need to know about company cars and the electric revolution. 17th of March, it's on networking skills and tips from Sarah White at Network In. On the 31st of March, we're still hoping to have our question time event at Macclesfield Rugby Club. And on the 28th of April, staff retention, how to look after and keep your staff. So I'm going to stop sharing my screen now, and I'm going to hand over to Chris Bentley and make him a presenter. And over to you, Chris, on who's going to take us through how to prepare your business for sale.
Right, hang on. Thank you very much, Stephen. Hopefully, hang on, we're going to get the presentation up and showing properly. Not sure why it's frozen at the moment.
Just want to click on slideshow from beginning.
Yeah. For some reason, it's not allowing me to move PowerPoint at the moment.
Let me see if I can open it. Can I come out of it? It shouldn't make any difference. So bear with me 1 second. Okay. 1 sec. I will share my screen. I'll make myself presenter again.
Yep.
Okay. And I will share. Okay.
That looks better, and that yours is allowing you to move.
Yeah.
Thank you. So today's webinar, thank you, Stephen. I'm Chris Bentley, and I'm going to take you through the main part of today's webinar, which is about preparing your business for sale. Now, the starting point, have the next slide, please, Stephen. The first question to ask yourself, or the first two questions to ask yourself, is why are you selling your business and who is the likely buyer? The answer to those two questions is going to determine your approach. Are you selling because you need to? Are you selling because you want to? Are you selling on the open market to raise cash, or are you actually transferring it to the next generation? Completely open questions, nothing to say you should do or shouldn't do one or the other, but it is going to frame your thought processes for how you dispose of your business. The other question that's really worth bearing in mind right from the outset is, who is the likely buyer? If you haven't thought about who might be willing to take on your business in 5 years' time, then you might struggle to sell it. You want to be looking at something that can be packaged up and sold on. Some businesses suit very well because there are consolidators in the industry, people who are going around buying up multiple businesses with the idea of putting them together to make a bigger whole. Other industries, you might be in a startup and therefore venture capital or private equity might be interested. In other cases, your more likely buyer might be another similar business, possibly even a competitor. It's difficult to know who it might be. There's certainly not one rule for everyone, but a bit of thought as to where the business might be going so that you can shape it in a particular way that it is attractive to that buyer. It's worth bearing that in mind. So if I come on to the next slide. Thank you. I'll start by taking you through at a very high level what the sale of a business might look like in terms of process. You'd start by making the decision that the business is up for sale. I've deliberately put it in inverted commas because it might be that you're transferring it to the next generation. It might be a management buyout. You might not need to actively market the business. You might receive an unsolicited offer. So we've got an offer. Some come in. We need to do a bit of negotiation. You might accept that offer. You might refuse it. But let's say we've now got to a position where you're happy with what you've been offered. You're moving forward towards a sale. The next stage is usually what's known as heads of terms, which is typically a brief 2-3 page document setting out the key terms relating to the sale. What's the consideration? How much of it's deferred? Is there going to be a working capital adjustment? Are the a seller's going to be tied in for a period of time. Is there anything that needs to be extracted beforehand? What's the proposed timetable? And typically the only other clause that's in there, but it's often the most important one, is exclusivity. At that point, you're likely to be giving exclusivity to your proposed buyer. So you can't go around being a tart towards other potential buyers of the business. It protects the buyer, and it also to a degree protects the seller, because you're both working together to achieve that deal. Once we've got that in place, you would need to get lawyers, accountants ready to go. The buyer's got to do most of the work here in terms of the diligence. They're going to go through the company on the legal side, from a commercial side, from a financial side, from a tax side, looking at your employment practices, basically trying to find out as much as possible about the business, identify any potential problems in there, so that they're aware of them before committing to the purchase. If there's a significant problem identified, they might well insist on what's known as an indemnity. So that means if any liability comes out of that, arises from that particular problem, it's automatically passed back to the sellers. You may also find that, particularly if you go through from the diligence stage into the draft sale agreement, which is pulled together by the lawyers in conjunction with each other, that the buyer insists on a lot of what is known as warranties. Warranties are broadly statements which the buyer is asking you to make as being true. Now, quite often that statement won't be true and you make a disclosure against it. If you've done that, the buyer can't come back at you. But if you haven't told them that, it's something they can potentially come and have a go at you, sue you for some of the deferred consideration, maybe ask you for some of the money back on later. It's essentially belt and braces diligence. We've got through that process, we've provided all the information, we've had the negotiations over the sale agreements, buyer's happy, you're pulling your hair out because you've had enough of the sale process. We finally get to completion. And this is when you, as seller, get your money, you hand over the shares in the business, you hand over the trading assets, the deal is done. However, you might be thinking that's the end of it. Unfortunately, it often isn't the case. You might have sold the business, but there's often something that still needs to be done, whether that is what's called completion accounts, so a set of accounts for the business drawn up at the date of completion, which might tweak the consideration slightly. There might be elements of deferred consideration still to be paid. You might have to remain part of the business for those to be paid. There might be what's called an earn-out, so you only get your deferred elements of the money if the business makes particular targets. And you may also be required to provide services in the form of consultancy to the ongoing business, even if you thought you were getting out completely for a short or medium period of time. Eventually, though, that comes to an end, the business is sold and you're done. However, what I would say from our experience of dealing with business sales with clients, that marketing the business is often the hardest bit. It's the bit that takes the planning, getting an offer, finding someone who might want to buy your business is generally harder than working through it. We've dealt with clients who spent years trying to find a buyer for their business. Once they found one, it often goes through in a few months. But the rest of that process, it's months, it's not weeks. It definitely be working on the basis in your mind that this will take some months to complete. So having sort of gone through the sale process to high level, so you know what might be expected of you, I'm just going to ask Stephen to pop over to the next slide, which lists out some of the potential buyers that there might be for your business. They range from the management team, often one of the best people to sell to if they can raise the money. They know an awful lot about it. They're not going to need to ask you too many more questions. You know that the culture of the business continues. Similar to that is an employee ownership trust. So you're selling to the employees as a whole, has tax benefits, has some structuring benefits, but it isn't appropriate for every business. You might be selling to another owner-managed business, or as we go through to private equity or venture capital, or even a listed company, each of these businesses is likely to take a different approach to their diligence. As you go up that list towards listed company, they're going to do more and more diligence. They're going to worry more about potential problems in there, as a rule of thumb. They will also have different approaches as to how long they want to tie you in, how much do they see you as important as the handover, how tightly do you need to be tied in. So there will be different approaches depending on who your offer comes from. Thank you, Stephen. Can we pop over? So I'm going to focus for the majority of this webinar on the planned sale of the business. So I'm going to assume that you actually want to sell your business. You're not in receipt of an unsolicited offer. What you need to do if you're thinking of selling in the next few years. First question we pop over is to think about what you might be selling. There are two main ways of selling a business. And I'm assuming here your business is a limited company and not a sole trade or a partnership. Because the vast majority of businesses that we do sell are in the form of limited companies. The first question is therefore, are you going to be selling the shares in that company, or will you be looking to sell its trade and assets? Now, as the seller, from a tax perspective, you will want to sell, in almost all cases, the shares in the business. The reason for that is you sell the shares, you will get away normally with 10% tax on the first million and 20% thereafter. That is your entrepreneur's relief, or as it's now properly known, business asset disposal relief. However, the buyer might just want to buy the trade and assets in the business. If they do that, then the company will pay corporation tax on any gains realised on the disposal of those assets. That might include a significant amount for the goodwill of the business, and that's taxable at 19%, rising to 25% in April 2023. So it's less tax efficient to start with. It also means you've then got to get the money out of the limited company, which is where, with a liquidation, you might get your entrepreneur's relief, your badge relief, business asset disposal relief. But the tax burden on a trade and asset sale is significantly higher. At the moment, it's typically about 27% as opposed to 10 on a share sale. That said, the buyer will often want to buy trade and assets because it's cleaner for them. They don't take on any of the history of the business, and they don't see winding up in your tax bills as their concern. Sometimes you're forced into trade and assets. Maybe there's a major problem identified in the diligence, although most buyers we find will at least start with a share sale or share purchase because it's more attractive and it helps them to get the business. One other thing just to note at this point is that if you're planning to sell the company shares, there may be assets within the company that a buyer might not want. Most commonly, that's properties or cars. Cars can be taken out reasonably easily because the value isn't usually excessive. But if you've got properties in there and you want to retain the properties, or a buyer doesn't want to buy them, this needs to be considered at an early stage. There's lots of things that can be done, but it does need to be picked up early. So having moved through that, if Stephen pops over onto the next slide, start going through the various areas you'd want to look at when you're preparing the business for a sale. This is obviously focused quite heavily on what accountants look at rather than lawyers, because we are accountants, not lawyers, which is why the financial and tax bit is in first. The bits we can help you with, and which will help you get your business sale away, accurate management accounts. If you're the buyer of a business, or if you're selling the business, you want to be able to provide to your potential buyer an accurate position of how the business is doing. You'll typically be asking the buyer to make an offer. The buyer needs something to see what they're buying, and to base that offer on. If your last management accounts were your stat accounts that you did 12 months ago, it's not great. You want something more up to date. You want something accurate. Similarly, it might be worth considering having a statutory audit on a voluntary basis. These days, a limited company only has to have an audit, typically if its turnover is over approximately 10 million. But if you're going out to market and your business has got 3, 4, 5, 6, 7 million turnover, having the audit opinion that the accounts represent a true and fair view of the company's position is valuable. You present that to a potential purchaser and they're going, yeah, I know these accounts have got something to them. Someone's looked at these properly. We've had an independent accountant look at them. I can place a lot more store by these accounts than I could be by with a set of accounts that I don't know the accountant. Obviously, if it's Harts, we'd hope that the buyer would put store by it. But if you're selling to a firm down south who's got no idea who we are, having an audit opinion says, yeah, we've done extra work on it. Those accounts appear much stronger than they would without that audit opinion. The other one, if you're thinking of selling, is bear in mind that the businesses are typically sold on a multiple of recurring earnings. So you want positive results for the years that a buyer is most likely to look at. So if there's a load of problems, a load of liabilities that are coming out of the woodwork, stock that needs writing down, bad debts, what you want to do is you want to get rid of that early, as in an early stage in your planning. Get rid of the bad news and then produce a couple of years of accounts with good news in them, so that when a buyer comes along, they're looking at the good news and all the historic problems have been tidied up. On the tax side, there's also much you can do to make your business more attractive and appear more valuable. It goes without saying that any tax scheme or aggressive tax planning in the business is likely to be toxic to a buyer. Larger companies in particular will not touch with a barge pole the shares of any company that's done tax schemes. Their reputation comes far ahead of anything else, so it has to be tidied up if they're likely to be one of your potential buyers. But even another limited company, do they want to take on the tax risk, and even with an indemnity and the hassle of tidying up aggressive tax planning? Hopefully no one on this webinar has done any of that, but if you are looking at a company or your company has got any of that in it, first and foremost, it needs tidying up. Then move down to the sort of more minor issues. Quite a lot of small limited companies we see, there are personal and lifestyle costs in there. Strip them out for a couple of years before the sale. The part of what we would term minor mischief. Small business owners, everyone knows there's a lot of this goes on. But if you're buying that business, if you were buying a business, do you want the risks associated with it? A larger buyer definitely won't do. A smaller buyer might be a bit more pragmatic about the people who are off payroll, but there's an argument that they're employees. They will want to strip out the personal and lifestyle costs. They'll want the VAT straight, the tax straight on it. So get that tidied up beforehand. Come to the next slide, please. You're also going to want to look at the commercial side of the business to make it look as attractive as possible for anyone coming in. A few sort of common things to look at, although the business owner will know exactly what are the potential problems in their business. But common things that are worth sorting well in advance are: make sure you've got contracts in place with your major customers, if that's appropriate for your industry. Gives a lot more security over the income stream, makes the business a lot more saleable, valuable, attractive to a purchaser. If you've got historic disputes and issues in there, get those tidied up, get them agreed, similar to what we've said on the tax side. No one wants to be taking on a pile of historic problems. If your business has stock in it, get your stock levels to be an appropriate level for a couple of years beforehand and make sure your supply chains are robust. when we're seeing a business bought or sold that's got stock in it, often one of the big considerations is that an appropriate level of stock, like not too much, not too little. If you've got too little, it gives commercial problems when people want to buy stuff. If you've got too much, is it obsolete? Can it actually be sold? Or on a less problematic basis, have we just tied up too much working capital in stock? No one's going to thank you for having an inappropriate level of stock when you come to sell the business. And it's worth planning up front, because significant variations in stock that are difficult to explain can make a buyer nervous. And then also, more generally, has your business got appropriate systems and controls in place? Or is it reliant on you and you doing what you want? If it's the latter, it's worth putting those systems and controls in place, because a buyer will expect them to be there. It'll also help remove you from the business, which is something that will need to be done as part of the sale process anyway. So it's worth thinking what a business of your size should have. We can help quite often in terms of helping you design those if there are systems or controls that are missing. But broadly, the question you need to be asking here is, if someone were buying your business, what would concern them? If you were buying your business, what areas would concern you? Where would you see the areas of commercial risk? Work those out and then set about de-risking them, fixing those problems. Can we come on to the next page, please? In an awful lot of businesses, the people are one of the most important assets or parts of the business. When the business is sold, the people go across. So if that's the most important asset of the business, particularly in a service industry, how do you make sure that, firstly, you can go, secondly, there's a management team in place, and thirdly, that those management team are likely to stay in place, so that the buyer is happy to take them on, understands the business, and doesn't think, oh help, the management team are going to disappear off into the sunset 2 weeks after completion, and my newly acquired business will fall to pieces. So the first part of that, as you're preparing, you need to reduce the reliance on yourself as a business owner. Any buyer who takes on a business doesn't want the former owner sat there telling them what to do. Similarly, if you're selling the business, you probably want out. If the business is reliant on you, not only will you struggle to get out, but a purchaser isn't going to want to pay so much for that business, because they're thinking, I've got to put someone else in to do your job. I've got to worry about that transition. I've got to do an awful lot of work to get this business operating as it is now, and you're not going to be there. So you're likely to achieve a much lower selling price if the business is reliant on you. The management team, assuming you're big enough that you've got one in place, you want to be preparing them, getting them to take on more and more of the responsibility for running the business, because they're going to be needed after you've removed yourself. You probably don't want to tell them that you're planning on selling, unless you're thinking of selling to them, but they need to be trained up and in a position where they can take on your role. Equally, those individuals are probably the key individuals. Do you need to consider bonusing them or any other incentives to tie them in? Enterprise management incentives, EMI, are often valuable if you've got a business that is going to increase in value rapidly in a few years before sale. An EMI scheme is a good way of very tax efficiently tying in your key employees. Typically, that enables them to buy shares in the business at today's value, and in 5 years' time, for example, when you sell the business, they sell their shares immediately. They don't have to put any cash in, but they get a big uplift in value that's subject to capital gains tax rather than income tax. But they only get that if they're still around when you sell the business. So in the right circumstances, it's worth considering. Are there any issues in your employment contracts and notice periods that need dealing with? For example, if your key individuals are all on a couple of weeks' notice, that will be a worry. If your employment contracts had various terms that probably shouldn't be there in today's world, that would be a worry for the lawyers when it comes to doing the legal diligence. And I have to say at the bottom, are there any festering HR issues? We were acting for a business a few years ago. We're acting for the buyers. There was a whole load of correspondence in there about how the business owner had had a fight with one of the members of staff. It caused some amusement, but it also caused a bit of a headache because there was a problem there that had to be sorted out. These sorts of things need thinking through and cleaning up as far as possible beforehand. So if we pop on again. So having sort of thought around the commercial, financial issues of making your business look as attractive as possible, you also want to think about any tax planning you might want to do in advance of the sale or in the run-up to the sale. First and foremost, your objective is likely to be maximising your BAD relief, business asset disposal relief, entrepreneur's relief as it was formerly known. Everyone's now got a 1 million lifetime allowance. That used to be 10 million, it's now only 1. And you have to have held the shares for 2 years to achieve that. Sometimes we find that you've got a husband and wife owning shares, and what we need to do is split them to 50-50 ownership rather than the former 75-25 to make sure that both parties use their million in full. Another case might be that you've got a couple, they put the shares into joint ownership only 12 months ago. So the spouse who didn't previously own shares isn't going to have the 2-year holding period. But if that spouse hands back their shares to the main business owner, we suddenly get entrepreneur's relief on 100% of the shares just because of quirks in the rules. Another area where planning might need to be undertaken is the trade-off between capital gains tax and dividends. It actually pays you to have more money, more cash in the business at completion, because typically the way transactions are structured, that additional cash will be added on to the sales consideration on completion. If that's the case, you'll pay tax on it, but at capital gains tax rates, 10 or maximum 20%. Whereas if the money had been taken out as a dividend prior to the sale, I'm going to assume you're a business owner at higher rate tax, you're talking 32.5, possibly even 39 and a bit next tax year. It's also worth considering your pension provision in the run-up to sale. Quite often we find that business owners have very limited pension provision. From a tax perspective, or let's just say, we can't advise on pensions because it's financial advice. However, the tax benefits are enormous, and therefore, depending on your view on pensions and what advice you've been given previously, you may well want to consider making significant pension contributions from your company in the run-up to a sale. Cash comes out very tax efficiently where that's the case, and you've got the money for the future in the pension fund. It may be you draw it down in a smaller number of years if it's a retirement type sale. It might be that you're actually looking at it as long-term inheritance tax planning. There's a lot that can be done. Similarly, if there's an asset that you want to retain, then selling that asset to a SIP, a self-invested personal pension, might be a tax efficient way of extracting that property, as well as making use of the very valuable tax relief for pensions. And finally, I've added the merger on the bottom. If all else fails in terms of splitting a group apart, the demerger is your last option. It's complicated from a tax perspective, it's complicated from an accountancy perspective, but it might be that you have to go down that route to split assets you want to keep from those you want to retain. If you do need to do a demerger, it's again one of those things that you would want to be looking at 2-3 years in advance. So if I come on to the next slide, which just summarises the 2 real key messages, which are, if you're planning to sell your business, you want to plan early, 2, 3, even 4 or 5 years in advance. And the second one is when you're working through each aspect of your business, if you were buying that business, how would you see it? You want to make your business as attractive as possible to a potential buyer. It'll help you achieve more, and it'll make the diligence process less painful. So I'm just going to move on to the next section of the webinar, which is to talk very briefly about business valuation. Valuation of business could be a webinar in its own right. It's not simple, it's an art, it's not a science. It's extremely subjective for small limited companies, as there are very few comparisons available. We do get data on multiples that are typically achieved from various sources, so we can get an idea of typical trends in multiples paid, trends in values of businesses. But those are drawn from various different businesses, hundreds of different cases. None of those businesses will be likely to be particularly comparable to your own. They might be in the same industry, but are the management team the same? Are the contracts the same? Are they in exactly the same niche? The answer is almost certainly not. Your businesses are very likely to be, if not unique, very unusual, and therefore you're not going to get an immediate comparison. Similarly, the bargaining position of buyer and seller needs to be taken into account, and you do find that two very similar businesses can go for very different amounts depending on the relative bargaining positions of the two individuals. I take an extreme example. You've got a seller who is desperate to sell because they've recently received bad medical diagnosis. They just need to get shot of the business because they're not going to be here much longer. There's not another generation to take it on. That business, the seller's in a weak position. It will typically go for significantly less than it would be if the seller had time to actively market and actively seek out a good buyer for the business. On the other end of the extreme, you might have a buyer who is desperate to buy you to shut you out of the market. They see you as a competitor, as a threat to them. That buyer will typically be prepared to pay over the odds, often significantly so. So we can see cases where a business that might come with a fair value of $1 million could go for 1.5, 2 million, or as much as $500,000. So it is very, very subjective and depends on the buyer and seller's positions. That said, if you're looking at what your business might be worth, it's worth having an idea of how businesses are typically valued. And they're typically, a small trading business will typically be valued based on a number of years of recurring profits. Now, your profits in the profit and loss account for this purposes will need to be adjusted to remove one-off items. Has there been a particular windfall in a year? Has there been a particular cost that wouldn't be expected to recur? Any buyer would also look to take out the amount you put through payroll and put through a fair salary for your role in the business. I'm guessing most limited company owners on this webinar are putting through a salary in the region of 10 to 12 grand for themselves. They might have family members on there as well. But how many of you think your actual salary should be 10 or 12 grand? If you had to pay someone to do your role, I think you'd probably be paying them a lot more than 10 or 12 grand to do that. So we take out your role, put in a fair salary, and that would adjust profits before we multiply it to get a number of years of recurring earnings for evaluation. We typically look, when valuing a business, to average profits over 2 to 3 years to smooth out particular years. If there's one year that's been affected more than another year, get an idea of how the business is on an ongoing basis. That's difficult at the moment because COVID has affected businesses in very different ways. And depending on the sector, you'll take a different approach to how you're averaging, or even potentially the hospitality industry, whether you could average the last 2 or 3 years, or whether you need to look at the last few months and what happened beforehand. it's different for each business. We would then multiply those adjusted recurring earnings by a number, and it's difficult to be more precise than that, depending on the qualities of that business. The lower number applies to businesses where the income stream's not particularly secure, where there's low barriers to entry, where there's a lot of competition, where the trade is very easy come, easy go. And at the bottom end, you might only manage to be looking to achieve 2 or 3 times recurring earnings. At the top end, we frequently see businesses going at 5 or 6 times recurring earnings, where there's a secure customer base, you've got a niche, you've got recurring earnings, your customers keep coming back to you, it's difficult for them to move. There's a reason why they come to your business rather than any other business. Are we still there, Stephen? My screen's just popped out. Yep.
Yep.
We're still good. Okay, so we'll move on to the next slide, having sort of discussed a very high level about what business is worth. So when you're selling, you would want a potential buyer to make you an offer. You don't want to be going out saying, normally my business is worth X thousand pounds. You're only going to get talked down if you try to do that. And other than the very smallest businesses, we don't generally see businesses put on the market with a named selling price. Shops, chip shops, that sort of thing, yes, you might do, but not the sort of businesses that I think most of you from when I saw the list up front have. We can provide you with advice around the valuation of your business to help, and we can also help comment on offers you've received to help you decide whether to accept it or whether to reject it or negotiate for more. However, the key bit to remember is the value of your business is ultimately what you're prepared to sell it for. We can't tell you that, only you can know that. And for that reason, we wouldn't do a valuation to say this is your selling price. You're the person who needs to know that. We can guide your thinking, but we can't tell you. And it's vital as you go into negotiations that you know how much you'll be prepared to accept. So that's that section. And then the final section I've got is just what are the alternatives to a planned sale? So we do see businesses disappearing in other ways to buyers in other than in a planned manner. It's not unusual for there to be an unsolicited offer. So it's worth having an idea at any point, what would it take you to dislodge you? Obviously, if you've had an unsolicited offer, you're not going to be doing any of the pre-sale planning, but you probably still want to have an idea of what your business might be worth, and therefore, should you be accepting that offer? But again, even if you think you might be, just weigh up your lifestyle considerations at that point. A common way to move on a business is actually to sell it to your existing management team. Some of the planning goes through, but the management team know most of what's in there anyway. So it's a different kettle of fish. Similarly, transferring to an employee ownership trust might be worth considering. There are tax benefits. It can pay you over a number of times, potentially out of its cash flow. So one of the problems with a management buyout is often raising the funds to do it. With an employee ownership trust, it can more often be paid for out of cash flow. The downside for a lot of businesses with this is that there is an all employee ownership requirement if you're going down the tax advantaged route. That's appropriate for some businesses, but might not be for all businesses. Or indeed, the other alternative is you don't look to sell your business, you look to pass it on to the next generation. And at that point, this is probably a whole separate webinar again to talk around the capital gains tax, inheritance tax considerations. Do you want to be thinking about using trusts? Is the planning around school fees that needs to be done in there? Might there be possibilities of dropping it down or part of the shares down 2 generations? If you've got family that want to take on your business, it's worth having a different conversation to what we've been talking about previously. And equally, if family are going to take it on, are you charging them for it? How much? And if so, how much? or how much of it is it in early inheritance tax? Lots of different questions to ask at that point. So that, I think, takes us to the end of the webinar, and I'll hand back over to Stephen at this point with the slide on the next webinars.
Thank you very much indeed, Chris. That was very informative. If you've got any questions, we'll just go through them. I can't see the chat box just at the minute, but just to remind you of the next webinars, which we've mentioned earlier on. So the next one's on the 3rd of March. All you need to know about company cars and the electric revolution. It's a number of questions we get asked on company cars, and should I put my car in the company or should I pay for it privately? What about electric vehicles? It's one of the most commonest questions we're asked. So we're going to try and run through a whole load of scenarios for you. On 17th of March, we've got some networking skills and tips. 31st of March, we're having our next question time event. The picture you see up there is the previous one, which we held at Macclesfield Football Club. And then on 28th of April, staff retention and how to look after your staff. So I'm going to come out of that and just see if we've got any questions in the chat box. Okay, question is, I've got one question. How does an inheritance tax work? Is it based on family?
Inheritance tax is based broadly on what the value of your assets is at the date of your death. It is possible for a married couple to pass their allowances to each other, but broadly you're looking at the value of assets on death.
Okay. From Helen, that was really interesting. Thanks. What are your thoughts on going through a company that markets your business on your behalf?
It's often very valuable to do that, because these companies do have lots of contacts and might well find a buyer for you more easily than you would do trying to market it yourself. That's the benefits of such businesses. The downsides are that they are typically quite expensive, and the other downside is we often find that people fall out with their corporate financiers, and I'll leave it at that.
Okay, great. Has anybody else got any questions they want to ask? That's all the questions we have in the chat box. Or if you want to unmute yourself, feel free to do so and just shout out and give yourself a couple of minutes. Next question is, how can one know if appropriate systems and controls are in place? Presumably that's if you're buying the company. Well, that would all be part of the due diligence work that you would do on buying a company. So you would look at all the systems and the controls that are there. You would have a look to make sure that the processes are what they should be. Often an audit could do that as well. So where we mentioned that potentially you might want to have an audit, that could also give you some comfort in relation to that, because those are the sort of areas that are covered in an audit process. Are there any other questions? No. Thank you very much indeed for everybody for joining us this morning. We've got a good number from around the world this morning, which is fantastic. Thanks again to Chris, who's our tax director at Harts, for giving the presentation this morning. And if anybody's got any questions, please feel free to contact us at info@harts-ltd.com. You can catch up with this webinar later on YouTube. If you want to go over anything, feel free to do so, and you can catch up on any previous webinars. But thanks very much again for joining us this morning, and have a great day.
Thank you. Bye-bye.